If a central bank has one defining mission, for most it is managing inflation. Keeping the general rise in prices under control is at the heart of what modern central banks do. Understanding why reveals their central purpose. Recall that inflation is the general rise in prices across an economy, which erodes the purchasing power of money. Central banks aim to keep this inflation low and steady, not zero, but modest and predictable. Stable prices are widely seen as essential. They let people and businesses plan, save, borrow, and invest with confidence, knowing money will roughly hold its value. Both too much and too little inflation cause problems. High inflation erodes savings, distorts decisions, and creates uncertainty and hardship. Falling prices, or deflation, can also be damaging, discouraging spending and weighing on the economy. So central banks aim for a moderate, stable rate in between, steering away from both extremes. To manage inflation, central banks primarily adjust interest rates and influence the money supply, which we will explore. Broadly, if inflation is rising too fast, a central bank can tighten, raising rates to cool spending and demand. If inflation is too low or the economy too weak, it can loosen, lowering rates to encourage activity. It is a constant balancing act. For example, when inflation climbs too high, a central bank raises interest rates to cool demand. When it falls too low, it lowers them to encourage spending, constantly steering prices towards steady rate. Central bank mandates, tools, and targets vary from one country to another, and they change with economic conditions. Even economists disagree about how policy and money creation really work, so check which institution sets the rules where you live. The main lesson is simple. Managing inflation, keeping the rise in prices low and steady, is the core mission of most central banks, because stable prices protect the value of money and underpin a healthy economy.